What's up, everybody? Today we are going to be taking a look at 5 stocks. I would say that all of them are value stocks. They're all reasonable quality companies. 3 of them are companies I've never talked about on the channel before. One of them I think is offering excellent risk reward today, and they're all trading right near their 52-week low. Now, keep in mind, just because a stock is near its 52-week low, that certainly does not mean that it's a buy. There's all sorts of reasons a stock could have dropped in price, and many stocks near their 52-week low are likely to drop even more. You have to look at the business and ask yourself, what are reasonable expectations for the future for this company? Sometimes a stock is sold off just because there's been a lot of recent negative sentiment around the company. And yes, in those cases, a stock being near its 52-week low might signal that it's a buying point. So let's jump into these companies. As always, none of this is a recommendation to buy or sell any of these stocks. If you get value out of the video, subscribe to the channel. We just passed 3,000 subscribers, so thank you so much to everyone who's followed along. And if you want to grab my sheets, if you want to put whatever ticker you're looking at in here and just instantly create one of these little valuation sheets that I make, then I will be having this template up on Patreon in just a couple weeks. I'm just working on getting my Patreon set up right now. So hopefully 2 to 3 weeks, that's going to be out. I'll let you know here on this channel. Now, let's get into the first company. And I think we're going to start with Murphy USA. If you live in the USA, especially in the middle or south, I'm sure you know this company. They have a bunch of gas stations and convenience stores all around the US. They serve, they say, 2 million customers a day. So very simple, boring business, gas stations and convenience stores. And this simple, boring business has been a long-term absolute winner. Pretty hard to find many significant dips on this stock. Even during COVID, it didn't go down that much. But, over the past year, down about 26%. From its peak, down a little bit over 30%, and it's trading at a reasonable valuation right now. This is a very thin margin business, but one of Murphy's advantages is their scale. They have over 1,700 stores. They're still growing. They're expanding into new areas. Because their store count is so big, their corporate overhead is a relatively small percentage of the revenue of this company. So yes, operating margins are hovering, 3 to 5%. This is a low single-digit margin company. I mean, a lot of the sales, of course, are gasoline. And we see as the price of gasoline goes up and down, the revenue goes up and down for this company. But the profitability, the bottom line, what's actually important to them is a lot more consistent. They're taking a little cut of that gasoline sale, whether oil is $100 a barrel or $60 a barrel. So through sheer scale, this company is churning out a respectable operating income. This is a very well-run company, low-cost stores. That's important here when the margins are so thin. And with all the cash that they make, they use a ton of that to buy back stock. Roughly half of their cash is going to CapEx, growth, buying up a few other little stores here and there, and the other half is going back to shareholders. They eat up a massive amount of stock. So going to our sheet and seeing, what we could expect for a return on our investment in Murphy USA today. If I just assume the top line grows a little bit above inflation, maybe 5% every year for the next 5 years, and I keep their operating margins similar to, where they have been, 3.5%, 4%. Maybe we'll put this at 3.5. And if I give them a 13 times multiple, which I think is reasonable for a company that is this well run with, slow growth on the top line, we were giving them 5% growth, then I'm looking at a 10% return every year for the next 5 years for Murphy USA. I think these are assumptions that the company is likely to hit. They certainly could outperform. If I cut our assumptions down, 3% revenue growth, 3% operating margin, a little less free cash flow, and, maybe only a 10 times multiple, then yeah, now you'd be down on your money after 5 years. And, in the bull case, they expand stores a little more, they hold 4% operating margins, and, we give them a 15 times multiple, then yeah, 20% return for Murphy USA today. I think overall, the risk reward is reasonable. It is a simple, boring company. I like those kinds of companies. It's not quite cheap enough for me. There's maybe some long-term concerns about gas stations as there's more and more electric vehicles on the road, but I think I'd be pretty interested in this company in the mid 200s. Maybe if it drops below 300, I'll take another look. Now, let's move on to the second stock, and it is Lululemon. We're not going to do a deep dive here. I made a video on Lululemon about 2 months ago, a month and a half to 2 months ago. I'll put a link to that video in the description if you want to check it out. At the time, the stock was $236 a share. I said I thought it looked like value. It looked decent, but I am going to wait. In fact, in that video, I said I would really like to buy this stock, more like around 190. And today it's sitting at $200 a share. This is a decent quality company. They've had incredible revenue growth, earnings growth, gross margins high 50%, operating margins above 20%. For an apparel company, an apparel retailer like this, these are very good numbers. People are concerned because the growth is slowing down, especially in the US. The growth in Lululemon is slowing down. Overseas, in some international markets, growth is still reasonably strong, but US growth is almost flat. And whenever a growth story stops becoming a growth story, you're going to see that reflected in the stock price. A lot of growth investors are just going to sell it off. This company is down more than 50% from its peak. Even over 5 years, it is down 44%. You can see the assumptions I made here in my base bear and bull case from a month and a half ago. I still think that these are pretty reasonable. I'm only assuming in my base case 6% growth on the top line. That's just a little bit of growth over inflation. 20% operating margin, so I'm actually assuming that margins pull back a little bit from where they are. And I'm only giving them a 14 times multiple, which for a decent quality company with mid-single digit growth, I think that's pretty reasonable. I mean, even if I lower some of these numbers, if I only give them a 12 times multiple, you're looking at 14% annualized return over 5 years. That is close to a double on this stock for what I think are reasonable assumptions. My bear case assumes no growth above inflation, assumes operating margins pull back fairly significantly to 18%. Free cash flow drops a little bit as well, and I'm only giving them a 10 times multiple. And even in this case, you are actually still up money on 5 years. Yes, this wouldn't be a great return. You probably wouldn't be happy with 3% annualized, but you would be up money on 5 years. And obviously, if the company outperforms, they continue with, 10%-ish revenue growth annualized. Their margins basically just stay where they are. And I give them a 20 times multiple, which is a little bit high for a retailer, but for a quality company with 10% growth on the top line, definitely not a crazy valuation for a bull case. And in this scenario, you're looking at 32% annualized over 5 years. That would be an amazing return. So overall, I think Lululemon is just too cheap today. I think it's a buy. That's just my opinion. I don't currently own the stock, but I am thinking about taking a position here. I have a lot of companies I'm interested in, and obviously I only own a few in my portfolio. So it's definitely a high bar to clear, and that's why I don't own Lululemon yet. That's why I was not buying at $230, $240. But today at $200, I think risk reward looks good. Just my opinion. Now, let's get into the third company, something totally different here. It's Merck. This is a pharmaceutical giant. They are a $210 billion company. This is a very large operation, over $60 billion in revenue a year. And right now, it appears to be trading for a decent valuation, only 13 times earnings. And the stock is down quite a bit over the past year, about almost 30%. Over 5 years, it's basically flat, essentially right where it was 5 years ago. This company produces a bunch of different drugs. A lot of them are cancer drugs. They are very big in the oncology space. Their pipeline is reasonable. Profitability is strong. They make about $20 billion in operating income. They're buying back stock. They have a great dividend. So it seems reasonable, but I'll tell you what my problem is with this company. Of their roughly, $16 billion in sales for this quarter, about half of that was from one drug, Keytruda. This is a cancer drug that has been just an absolute blockbuster for this company. And they're going to lose their exclusivity on this drug in 2028. That is when their patent expires. So in just 3 years, there's a big question mark in my mind of where is their revenue going to be? Where's the profitability going to be when they lose their exclusivity on this huge drug for them? They say they're well positioned to successfully navigate the Keytruda LOE period. LOE is loss of exclusivity. Basically, their patent is expiring. They say, their pipeline looks great. They have new growth drivers. But for me, this is just too big of a question mark. If you follow the channel, you know that I have a pretty significant bet in the health insurance companies. I own Elevance, Centene, UNH. I've talked about these companies a number of times. I just think it's an easier bet to make than, buying a company like Merck, which, yes, it looks cheap. Yes, they return a lot of value to shareholders, but it's not cheaper than, Elevance, for example. And you have this huge question mark on what's going to happen when their main drug loses their patent in 3 years. So Merck is just a pass for me. I'm not even going to put in numbers for a base bear and bull case. I don't think I can predict their revenue growth 5 years out from now. I don't think I can predict their margins, so I'm not going to try. I'm just going to move on. And the fourth company we're going to look at is Equinor. I think that there are a lot of cheap oil producers right now. I made a couple videos recently on where I think the opportunities are in the small upstream producers. I had a comment on one of those videos asking me about Equinor. It is trading close to its 52-week low. We see since the peak in 2022, it is down, 40-ish%. They have a staggering 9% dividend, which I think is attractive to a lot of investors. So we're going to talk about Equinor today. Because a lot of oil companies have different amounts of debt, different amounts of leverage, it is very common to look at, a multiple like enterprise value to EBITDA to value these companies to compare from one to another. Enterprise value takes into account not just the equity, not just the market cap, but also the net debt of the company. And you're comparing that to the earnings that would be attributable to either the equity owners or the debt holders. It's earnings before interest, taxes, depreciation, and amortization. So the logic of looking at this ratio makes sense. And when you look at Equinor, it looks like it is dirt cheap. It's trading for less than a 2 times EBITDA ratio. But one thing that people sometimes forget in EBITDA, it's earnings before interest, taxes, depreciation, and amortization. If you're comparing between companies that pay similar tax rates, that's fine to use this ratio to compare those companies. But Equinor, they pay an absolutely massive amount of tax to the Norwegian government. We see here, earnings before taxes, $30 billion, $22 billion in income tax expense over the past 12 months. This is not some fluke. They don't have some big tax hit this year. Every single year, they are just paying a massive amount of tax to Norway. So, don't be fooled by their EV to EBITDA multiple. If we just look at this company on a cash flow basis, though, they're still making a boatload of cash. Once you take into account their CapEx, free cash flow still looks pretty strong. Obviously, when oil prices were high in 2021, 2022, they were raking in a boatload of money, over $20 billion US in free cash flow. Keep in mind, this is a company that is trading for a market cap of $60 billion US. Right now, at today's prices, we'll call this, roughly $8-ish billion in free cash flow. For a $60 billion company, you're talking, 7 to 8 times free cash flow here. That's still pretty cheap. It's not as cheap as you might think it would be, just looking at 2 times enterprise value to EBITDA. But still, for a large major company, this is not trading for a demanding valuation. And I don't think that we are in a high price oil environment right now. They focus on free cash flow and cash flow in general a lot in their presentation. I like to see that. They're committed to returning capital to their shareholders, which I also like. And the debt that they have on their books, it's acceptable. A lot of these oil companies, they have quite a bit of debt. It's by its nature a very capital intensive business, but on their books, about $24 billion in cash and short-term investments, and debt that they have, about $30 billion here. If I were to add up long-term plus the current portion of this, $30-ish billion in debt. Yes, that's a lot, but given their cash flow and their cash position, it's actually fairly reasonable, I think, especially compared to their peers. Overall, I think Equinor is decent. As far as the major oil companies in the world, Equinor and Petrobras are cheaper than, the Exxons of the world. So I think it looks all right. They're not the lowest cost producer out there. They say their break-even oil price is, about $50 a barrel, which is not a low-cost producer. So if oil prices drop and they stay low for a very long time, of course, that's not going to be great for an investment in Equinor. But, if oil prices go up, this also means they have a lot of leverage to the price of oil. Remember what happened in 2021 and 2022. In those years, price of oil was high, free cash flow absolutely off the charts. $20-ish billion in free cash flow on a $60 billion company. Obviously, that's extremely high. I'm not going to put this company into a stock sheet here because the revenue, operating income for this company, it's going to be heavily dependent on the price of oil. I can't predict that. And, even though I think Equinor looks decent, I don't own the stock. If you've watched my past videos on the oil industry, you know that I own a basket of small upstream producers. These are companies that are trading for ridiculously dirt cheap valuations. You're talking, 4 times free cash flow, sometimes less for these companies. So that's what I'm doing with my money. Just my opinion. Again, not a recommendation. Now let's talk quickly about the last stock, and it is Target. Target is sitting just above its 52-week low. It has not been a fun time if you've owned Target stock. Over the past 5 years, if you held this stock, you'd be down 37%. Even if you factor in the dividend, you are down probably over 20%. From its peak, the stock is down, about 65%. It's been a massive fall for Target. And for good reason. This is a slow growth company that was trading for, a 30-ish times multiple. Frankly, there are a lot of stocks in the market today that have metrics like that. They are are low growth companies trading for very high valuations. It's part of the reason I would argue that the stock market today is very richly priced. I'm not going to say it's a bubble, but it is historically expensive. Target, as we see from the revenue here, very slow growth. They had this post-COVID bump. Some of that was really just inflation making its way through the economy. I did make a video on Target about 3 months ago. At the time, I said it's just not cheap enough. The most recent quarter, same-store sales are down. They say that they're seeing improvement quarter over quarter. So sequentially, they say things are getting better. I'm not going to do another deep dive here. I don't think Target is dying. The question is just, is it cheap enough today to offer a decent risk reward? You can see the assumptions I made here in my base, bear, and bull case. These are the same assumptions I had 3 months ago. Let's take a look, see how reasonable they are. I have revenue declining slightly for the next 2 years, and then it returns to basically just growing in line with inflation. I have operating margins getting to about 5.5%, which is on the low end of where they've been historically. So I'm not assuming they recover the margins that they've enjoyed for, the past decade. And I'm giving them just an 11 times multiple. And if these assumptions come true, you're looking at a 14% annualized return on Target. That's roughly a double over 5 years. That's not looking too bad, especially considering I don't think that we made very optimistic assumptions here. My bear case is the Target starts dying scenario. They're dropping 2% on the top line every year for 5 years. Operating margin compresses to 4.5%. That would be a big compression on the margin for them. And I'm giving them just an 8 times multiple. And in this scenario, you're losing 4% of your money every year for 5 years. That obviously wouldn't be fun, but for how pessimistic these assumptions are, it's not really that big of a disaster. And as far as my bull case, I'm assuming no growth this year for Target. Then they return to, mid-single digit growth on the top line. Operating margins bounce back to 6%, which still would not be on the high side of where they've been. It's more towards about the middle of the range of where they've been historically. And I'm only giving them a 14 times multiple. And in that scenario, you are looking at a 25% annualized return, or a triple on your money over 5 years. I know people hate Target stock. There's a lot of negative sentiment here, but I think Target is getting close to a buy. I would say it's still not quite cheap enough for me, but I think the risk reward looks decent today. And if the stock drops more, I'm definitely going to be interested. So with that, I think we'll wrap up the video for today. In summary, Lululemon, I think looks very interesting right now. To be clear, I don't own a position in any of these companies, but Lululemon looking very interesting. Target, getting close, I think. Murphy USA looks decent, looks fine. I like the company, just not cheap enough for me. Equinor also looks fine for a major oil company, is relatively cheap. I just think I was finding better opportunities in that space. And Merck looks cheap, but I'm just going to stay away. So if you got value out of the video, subscribe to the channel. If you agree or disagree with anything I said here, let me know down in the comments below. And I hope to see you all in another video.